Welcome to today's deep dive. We are looking at the August 17th, 2026 market data. And, well, if you're tracking this right now, it's like looking at a heart monitor that's just a mechanical metronome.
Yeah, there is almost zero organic human momentum out there. It's totally algorithmic.
Exactly. Our mission today is to figure out why. We're going to decipher this massive market consolidation and look at how, major institutions and miners are restructuring just to survive this fiat liquidity drought.
Right, because we are stuck in this incredibly tight trading range.
We really are. The asset is trading 24/7, and it's sitting right at $63,568, which is up like 1.01% over the last day. But that's only after surviving a pretty brutal liquidity sweep down to $62,653.
Which is just those algorithms, temporarily plunging the price to trigger stop losses and scoop up the asset on the cheap.
Right. So without that organic fiat liquidity to drive an actual breakout, what are the heavy hitters the macro allocators actually doing right now?
Well, they're playing extreme financial defense. I mean, without retail momentum, corporate treasuries are being forced into these defensive financial games, and we're seeing them split into two very distinct strategies.
Strategy Inc. they're the perfect example of the first camp. They've completely paused their Bitcoin purchases.
Which is mathematically the right move for them.
Right, because their average cost basis is way up there, like $75,385. So instead of buying, they just repurchased preferred stock and fortified a massive $4.8 billion USD reserve.
Yeah, the math is bulletproof.
Yeah.
Retiring high-yielding preferred shares strengthens their balance sheet way faster than buying an asset that's trading below their average cost.
It's like having an underwater mortgage, You
Right.
don't take out a high-interest loan to buy a second house. You pay down your expensive credit card debt first.
Exactly. But then you look at a firm like Strive, and they're doing the exact opposite. They're aggressively accumulating.
Yeah, they just bought another 79 Bitcoin at around 63K.
Right, but the mechanism they're using is the fascinating part. Strive owns about 505,000 shares of Strategy Inc.
Oh, wow.
Yeah, so they are taking the dividend yield from those preferred shares to fund their operations and systemically buy more Bitcoin.
Wait, so it's basically a synthetic credit loop.
Exactly. They use the yield generated by another company's debt to fund their own accumulation.
That's wild. But while the treasuries are playing these complex financial games, the literal engine of the network, like the actual miners, are facing an existential crisis from this stagnant price action.
It is brutal out there for them. Just look at Bitfufu.
Right. They just posted a $20.5 million net loss.
Yeah, and a 73.6% drop in cloud mining revenue. Their margins are just collapsing.
Meanwhile, you've got HIVE taking a totally different route. They're making a massive $350 million pivot away from mining to offer AI cloud services using NVIDIA GPUs.
Which is incredibly lucrative right now.
But let me push back here. If leasing compute for AI generates like $500,000 a day, why doesn't every single distressed miner just rip out their rigs and pivot to AI?
Well, it comes down to the insurance data. The global sector just lacks the underwriting capacity for high-density AI hardware.
Oh, because it runs so hot.
Exactly. The hardware is wildly expensive, it runs at extreme temperatures, and the brokers are terrified of the catastrophic tail risks.
So if a farm burns down...
You're facing an astronomical payout. So insurers are forcing these massive loss caps. And if you're an underfunded miner, you can't secure the debt financing from banks because you can't get fully insured in the first place.
Wow. So you're just left holding the bag. And this structural squeeze, it isn't just hitting miners, right? It's forcing a complete Wall Street monopoly.
Absolutely. I mean, look at Hashdex. They're liquidating their 225.58 Bitcoin. The mega issuers are just starving out these subscale ETFs.
Yeah, by offering complete fee waivers and just absurdly deep options liquidity. It's impossible for the smaller funds to compete with that.
No, they bleed money every day just paying custody and audit fees. And honestly, this consolidation phase is going to last until the fiat liquidity drought ends.
Which means everyone is just staring at Wednesday's FOMC minutes.
Right, waiting on Chairman Warsh's policy cues, especially with, inflation expectations and oil risks creeping back into the picture.
So until then, if you're navigating this, keeping an eye on corporate credit health is key. And maybe looking into covered call strategies to generate some short-term yield.
Definitely a smart move in this sideways chop.
But this all leaves you with a really heavy question to think about. If physical custody, mining infrastructure, and these corporate proxy loops all centralize into a handful of mega-cap entities, what actually happens to the fundamentally decentralized ethos of this asset?